Okay, hello, econ students. Mr. P here. I mentioned to you yesterday I was going to have a sub, and I wasn't sure what we had planned, but there were some slides that I had missing on a subsequent handout, and so my sub should have passed that out. It should look like this: invest IRAs and investing, and it's got some buckets on the front there. What I'm going to do is, because my three econ classes, first block, fourth block, and sixth block, all ended in different places yesterday, I'm going to review some of the slides from yesterday's handout. So I believe my first block finished. So this will be a quick review for them. And fourth and sixth, you did not finish them all. So you're going to want to grab out the first investing handout, which should have a few slides left to finish up. And so I'm going to pull those up and share my screen with you. And that is going to be this slideshow over here. And we may have covered this. If we did, just kind of watch for the review. Capital gains, capital loss. When you buy and sell stocks, if you make a profit, we call that a capital gain. If you lose money on that sale of stock, like for example, if you buy some stock for $50 and you end up selling it for $40, you lose $10 per share. We call that a capital loss. And then there are these things called stock splits. And if you look over the graphic over here, sometimes when a company has a price that gets really high, they still want to make their stocks attractive to ordinary people, the middle class people. And so they would do a stock split. It doesn't really affect you financially. They just take one share of stock that might be worth $100 and turn it into two shares of stock that are worth $50 each. We're not going to go into the technical reasoning behind that, but the simple version is that they keep their price in a relatively normal range. Because of stock splits and such, you can't really tell by looking at a company's stock price on whether that is a good, well-performing company or a bad company. Just because one company might have a stock worth $100 a share and another company might have a stock that's worth $200 a share, you can't just look at the price of the stock and say, well, this is a better company. This is a bigger company, because all companies have different amounts of stock outstanding, different amounts of stock out there. Then there are income stocks and growth stocks. And simply, income stocks will pay a regular dividend. Dividend are profit payments. We're going to go into greater detail with those as we start our stock simulation. And growth stocks pay few dividends, but they reinvest their earnings. They will put a priority on growth, maybe build more factories, maybe buy more TV commercials or whatever that might be. So they're investing in growing the company. And then IPO, it stands for initial public offering. You guys are going to be doing an initial public offering during the stock simulation. It's when you or a company just makes available stock to the public, as it says, initial, first time, public, the public offering of their stock. And so it's the first time you can get stock. One of the most advertised IPOs in history was the Facebook IPO about 10 years ago, when Mark Zuckerberg sold to the public shares of Facebook. You and I could buy Facebook stock right now if we wanted to. Simply, a stockbroker sells stocks. Stockbrokers work for brokerage firms, or I also call them brokerage houses. In order to buy stocks, you have to go through a brokerage firm. Back in the day, you'd have to go through a stockbroker to go through a brokerage firm. But today, with electronic media, with cell phones, computers, apps, you can buy stocks directly from the brokerage firm with an app like Charles Schwab or Fidelity or Edward Jones or a few of these brokerage firms where you can buy and sell stocks. Day trading, this should be the last vocabulary term. This is high risk stock trading on a day-to-day basis. Everything I've talked about is long-term investing. For retirement, for example, it's buy and then just hold, not hold for a few weeks or a few years, but for several years. That is by far one, the easiest, and two, the best for your goal, your long-term goals for retirement and things like that. Day trading is almost like gambling. You buy and sell stock based on minute by minute fluctuations in the market. You'd get software and you'd put yourself in a position to buy thousands, hundreds of thousands, and even millions of dollars of stock, and then sell it a few minutes later when it makes 10 cents a share. And if you have thousands of shares, you would have made thousands of dollars in just a few minutes. And this is not recommended by Mr. Perry Ellis because it's very, very risky. Stocks are very volatile in the short term. And in the long term, they're not so much. In the long term, they tend to be a very good thing. And so you want to keep that very good thing going by not trying to mess around and gamble by buying, selling stocks on a day-to-day or even week-to-week basis. So one of the websites that, and this is not in the new slideshow or the old slideshow, is feedthepig.org. And if you get a chance, check this out. It's for students and young people to learn a lot of the same things that I'm discussing in my slideshows. Okay, so now we're going to need that new handout that the sub should have given you. And now we're going to talk about, we earlier in the week, we talked about IRAs, individual retirement accounts, like these Roths, like the 401ks and 403bs and so on and so forth. We like to, I like to think of these as like nest eggs. And the goose, here's a picture of the goose with the golden egg. Are you going to have a small little egg, or are you going to have a great big old golden egg when you retire? These buckets represent these individual retirement accounts. They're just like savings accounts, except for they're sponsored by the government, and you can get them through your employer. You can get them through these different investment houses like the Charles Schwabs and the Fidelities and Edward Jones and so on and so forth. And the thing with these accounts is they're just simply accounts. They're like savings accounts, but instead of putting money in them, you put investments in them. You start off by putting money in them, but then they come with these cool apps where you can direct where that money goes within that bucket, within that Roth IRA or that 403b for teachers, or the 401k, which most of you guys will get. Do I want to put a combination of stocks and bonds? Do I want to put mutual funds in there? Do I want to put just stocks in there? Do I want to put other things in there? And so when I kept referring to things like 401ks are going to be important to you someday, this is what I'm talking about. These buckets that you need to fill up, just like you would put money in a savings account. And by far the best and easy way to do that is on a regular basis. Maybe so you don't even see that money. So you don't have to, you're not tempted to even spend that money. Tell your bank, draw it out of my bank account and put it into my 401k, my Roth IRA. Or tell your employer to do that. They will do that as well. So let's look at the main differences. I really didn't get into this earlier this week. Roth IRAs were named after a congressman with the last name of Roth. That's where they get their name. And they are limited to a maximum of around $5,500 a year, $5,500 a year. The cool thing about Roth IRAs is you pay income tax on them now, today, or when you receive that money, but all your growth is tax-free. So just a quick example of that would be is if you invest $1 million, you pay taxes on it. If that $1 million made $1 million, so you now have $2 million, you don't pay taxes at all on the new $1 million that was created by the old $1 million through investments. And so you would have 2 million in money, but you would have only had to pay taxes on 1 million of it. Roth IRAs are not affiliated with your job, so you have to kind of go out on your own to do those. Again, it's as simple as downloading an app. If you're not 18 years old, it's as simple as getting your parents' permission on the app and having it start to draw right out of your bank account money for you to start investing. Now, 401ks, 403bs, and 457s, these are traditional IRAs, and they have to go through your employer. They go through your employer because they come out of your paycheck. And so when you hear about 401ks and 403bs and such, you're going to have a conversation with the benefits people, your human resource people in your job, where you work, and they will set you up with one of these and allow you to direct that money into certain investments. So you'll have a 401k, and then they'll ask you, well, what do you want your money that's going into this 401k, this bucket? What do you want it to be invested in? Do you want it in stocks, bonds? Which stocks, which bonds? Walmart, Amazon, whatever. And they are fed into those buckets by your employer, but it may come out of your paycheck, or your employers may do a match. This is the best situation. You hear about these all the time. Employers are now, because they're getting rid of those traditional pensions that I talked about that teachers and cops have, they're getting rid of those. And they're doing these 401ks, but they will help you with your retirement. Your bosses will. And the first thing you want to do when you get a job is, one, you want to ask, do you have a 401k available? Second question is, do you match? And match means if I put 2,000 in, they'll put 2,000. So they'll put 2,000 of my money in out of my paycheck, but then they'll add 2,000 of their money. So you'll have free money, free extra money going into your retirement account. That's what you really want to look for. As I see there, in my line, their traditionals are sometimes matched by the employer. The limit on this is much higher. It's $18,000 a year, and you will pay taxes on that later on when you retire. So you won't be able to avoid the tax man later, but you will be able to avoid the tax man today. On to our next slide. So I don't want to get into too much the mathematics, but you heard me say over and over that the Roth IRAs are better than the 401ks and 403bs and such. This graph kind of shows, and again, I'm not going to get into the mathematics here, but if you have a Roth and you are investing $5,000 a year at age 45 and 30 years, you'll have 38,000 versus 27,000. This is using some, rates of return, 7% and 30-year investing horizon and so on and so forth. So you don't really need to pay attention to this math. What you need to listen to Mr. P is the Roth IRAs are better. If you can do both, let's say you have more than the Roth IRA max of 5,500. Let's say you want to invest $10,000 a year into your retirement. Well, the first 5,500 would go into your Roth IRA bucket account, and then you'd put the rest in your 401k account. So the question is, how many buckets can I have? Well, how many savings accounts can you open? Can you go to one bank and open a savings account, another bank and open a savings account? Yes, you can. Nothing's stopping you from doing that. Same thing with these accounts. Usually you have one, but you're still going by those yearly limits. Like, for example, I have a Roth IRA. Mrs. Perry Ellis has a Roth IRA. And then Mrs. Perry Ellis and I have a combined, or what they call a joint Roth IRA as well. And so you can have as many as you want as long as you don't go over the yearly maximum limits. With the 401ks, you can have a ton of those. my son, for example, had one job. He got a 401k, and then he started another job. He got another 401k, and he's just letting the other one grow because his employer was feeding that one his first job, and his second job, that employer is feeding that one, and they're in different investments. If you were to get a third job, you'd have a third bucket. You might even have a fourth job and a fifth job throughout your lifetime. And is it possible to roll them over, to roll over or not to roll over? And that is, how many of these do you want to keep track of? You're allowed to have unlimited numbers of 401ks, and they're all growing simultaneously, but then you're getting different updates in the mail and you can get confused. And so I really wouldn't hold on to more than maybe 2 401ks. But what they will do is your current job will go back to your old job and ask them to roll that over, that money in that account, into your new bucket, your current job. And so these are called they're called IRA rollovers. And so you can do that as well. So let's get to this next topic, which is called diversification. Diversification is this idea that you don't want to put all your eggs in one basket. If you put all your eggs in one basket, you trip and fall, all the eggs are broken. And to use an analogy of your investment accounts. And so you don't want to just have one stock or two stocks. You want to have a lot of different stocks. So if one or two are doing bad, the others help to keep your portfolio of stocks afloat, your bundle of stocks afloat. And one of the things that you want to do is you want to avoid positive correlated stocks. So if, for example, the blue company here represents Ford and the red company represents GM, they're both in the auto industry. You might as well just own one or the other, because even though they're two different companies, the auto industry itself is highly cyclical with the economy. So when one is up, the other one is up. When one is down, the other one is down. And you'll see that they're not perfectly correlated. They don't match perfectly, but they kind of go together. We call this a positive correlation, and that is not spreading out your risk. What you really want to look at is looking at stocks and from companies that have a low correlation. And not just having two, but many, many different types of stocks of different low correlations. The best way to explain that is these are not real companies, but let's say you have a bathing suit company stock and you have an umbrella company stock. Well, in good weather, your umbrellas are not going to sell. Your umbrella company is going to be down. In good weather, your bathing suit company is going to sell lots of bathing suits. That stock's going to be up. When the weather gets bad, people buy less bathing suits and you see this downward trend, but people start to buy more umbrellas. You see this upward trend. All right. And so these stocks have low correlation. And when you want to diversify, when you want to spread your risk out, this is what you want to look at, is low correlated stocks. When you are able to correlate vast amounts of stocks and bonds and so forth, there's one last bit of diversification for you to do, and that is to diversify against a bad economy as a whole, something catastrophic like a world war or a Great Depression or something like that. And when the economy is going up, all right, what you end up having, or excuse me, when the economy is going up, what you end up having is you have, well, green is the economy. So economy's starting to go down here. All right, the S&P 500 is an index of the economy. The economy is starting to go down. People will switch to gold because gold and silver, precious metals, will start to go up. And when the economy starts to rebound and go back up, then you got the gold and silver going down. They're perfectly oppositely correlated with one another. And you'll see here green representing the American economy and the red representing the price of gold. And the reason why gold is a hedge, hedge is just a fancy word for insurance, is that let's say things go to hell in a handbasket. The stock market crashes. Maybe the Chinese take out our satellites. We can't communicate. There's no cell phones. We can't use our money and our credit cards and our debit cards because we need electricity. What do we need? Well, we need gold and silver to buy things for our food and for our family. We need some sort of money. And so that's why gold generally goes in the opposite direction of the economy. And with that, those were the last bit of notes I wanted to share with you guys. What I'd like to tell you is we're going to have a test tomorrow. And I know I'm just kind of springing this on you at the last minute, but I'd like to get everything done. And so my sub will also administer a test on the corporation notes that we did before spring break. You know, all that stuff on sole proprietorships, partnerships, and corporations. And then the newer handouts on investing, and especially this new one that we just completed. So I'm going to sign off now, and I'm going to send you off to my next video. The next video is an introduction to the Perry Ellis Street Journal stock simulation. The video you're about to see, I actually made last year during the pandemic to introduce the simulation to my students remotely. And I actually videotaped it from the airport in Phoenix. And you'll hear some background noise, and I'll make reference to some things that we may or may not have talked about in this year's class, but it will give you an idea. You don't need to take notes, just pay attention. It's going to give you an idea of what we're going to be doing in the coming weeks with this stock market simulation. So see you guys on Monday.